Every single bank is about to adopt XRP, XLM, and stablecoins. Let's cut through the noise. Banks laughed at crypto. They called it speculative, unregulated, fringe. Meanwhile, they quietly sent teams into backrooms to run pilots on the very rails they mocked: XRP, XLM, and regulated stablecoins. That's the part retail never sees. The public dismisses what the private labs test. And now those pilots are maturing. Integration meetings are happening. Compliance templates are being written. Rails are being wired in. By the time you get a press release, the switch was flipped months ago. Here's the uncomfortable truth. Global finance is already migrating to digital settlement infrastructure. Not someday. Not theoretical. It's happening right now in closed corridors between correspondent banks, central bank task forces, payment networks, and fintech gateways that speak blockchain under the hood. If you're still thinking of XRP and XLM as altcoins, you're playing checkers on a 4D currency board. Why should you care? Because when settlement changes, everything reprices. FX spreads, remittance fees, liquidity traps, even how fast capital rotates through markets. When money moves instantly and cheaply across borders, the institutions that control that flow get a new profit engine. And the assets that grease those rails stop trading like memes and start trading like infrastructure. That's where XRP, XLM, and compliant stablecoins come in. Let's talk pressure. Banks aren't adopting because they want to be cool. They're being forced by margin compression, by faster fintech competitors, by regulators pushing real-time data standards, and by customers who now expect send money like a text speed. Swift messaging alone can't deliver that. Nostro/Vostro pre-funding is dead weight. Multi-day settlement locks up capital. In a world of tokenized treasuries, 24/7 markets, and real-time commerce, legacy rails are a drag chute on a rocket. So what's actually happening? You've got wholesale institutions testing on-demand liquidity models where fiat converts to a bridge asset, hello XRP, teleports across a ledger in seconds, and exits in local currency, no pre-funded accounts. At the same time, retail and fintech corridors are wiring up to networks like Stellar, where stablecoins, USD, Euro, NGN proxies, you name it, move through anchored liquidity hubs and cash-out endpoints. Wholesale meets last mile. Banks sit in the middle. Fees collapse. Volume explodes. You will not get an email asking permission when this goes live. One morning, your international transfer just settles faster, fees mysteriously drop, and your bank quietly announces enhanced cross-border capabilities through a next-gen liquidity partner. That partner? Odds are it's plugged into XRP liquidity, Stellar rails, or a stablecoin corridor that didn't exist publicly 6 months earlier. The banking system is broken, and they know it. Let's start with the elephant in the vault. The modern banking payment system doesn't actually move money. It moves messages batched, delayed, fee-stacked, reconciliation-heavy messages that eventually result in value shifting after correspondent banks, FX desks, compliance filters, and settlement windows chew through them. When you send an international wire, nothing zips across borders in real time. Your bank sends a swift message. Intermediary banks reconcile balances. Nostro/Vostro accounts adjust. True settlement can take days, even when the screen tells you, completed. Meanwhile, global commerce runs 24/7. E-commerce storefronts, gig work, cross-border SaaS billing, global payroll, instant retail payouts, all expect real-time value transfer. The plumbing underneath? Built for the 1970s. That gap, real-time demand versus batch-era infrastructure, is where XRP, XLM, and stablecoin rails walk in and flip the script. The mechanical failure beneath every cross-border payment. Here's what slows the system down. Swift is not equal to settlement. Swift is a secure messaging layer. It tells one bank to debit, another to credit, but doesn't push the funds. The actual money movement depends on pre-funded correspondent accounts or delayed settlement across central bank systems. Nostro/Vostro capital drag. Banks park huge pools of idle capital in foreign accounts just so payments can settle when needed. That's trapped liquidity earning little return. Time zone and batch windows. Different national payment systems close at different times. If a message misses a window, your transfer sits until the next batch. FX spread layers. Multiple intermediaries each take a cut. Your $1,000 transfer bleeds before it even clears. Reconciliation hell. Slight data mismatches trigger manual review, compliance checks, or full reversals. More delay, more cost. All of this friction made sense when cross-border transfers were rare and high value. Today, small value, high-frequency flows, creator payouts, remittances, digital service settlements, slam into it like traffic trying to merge onto a dirt road. The pandemic stress test system exposed. During 2020 to 2021, when lockdowns froze physical operations, the world leaned hard on digital money movement. That stress test lit up every weak joint in the legacy stack. Companies trying to fund overseas contractors hit multi-day delays just when delivery timelines were collapsing. Migrant workers struggled to move money home as branch-based remittance providers shut doors. Business continuity teams inside banks watched liquidity buffers get pinned while FX volatility spiked, exposing how rigid pre-funding models were. Regulators started asking pointed questions. If we had to move stimulus, relief, or emergency funds globally at scale, could we? The answer was embarrassing. Behind the scenes, task forces spun up. Central banks compared notes. Payment networks, fintechs, and blockchain infrastructure providers got calls. The conclusion: patching SWIFT and legacy correspondent banking wasn't enough. The system needed programmable, always-on, low-friction liquidity rails. Enter the fix: purpose-built bridge and last-mile networks. This is where XRP, via RippleNet on-demand liquidity, and XLM, via the Stellar network and its Anchor plus stablecoin model, line up like lock and key. XRP/Ripple ODL, wholesale liquidity rail, designed for institution-to-institution value transfer without pre-funded accounts. A sending institution converts fiat to XRP, transmits it across the XRP ledger in seconds, and the receiving side settles out into local currency. The bridge asset handles pathfinding and deep liquidity across corridors without tying up capital. XLM/Stellar, last-mile currency access, built for people-level and fintech-scale payments. On- and off-ramps anchors, connect bank accounts, mobile money, cash networks, and stablecoins. With built-in order books and protocol-level FX conversion, Stellar can translate value between digital dollars, euros, pesos, or regional stable tokens that map to local fiat. Put simply, Ripple frees trapped institutional liquidity. Stellar delivers it to real users. Wholesale meets retail. Banks plug into both ends, one to optimize treasury operations, the other to serve customers with faster, cheaper transfers. Cost reality: the math banks can't ignore. Banks live on spreads. When infrastructure eats those spreads, they innovate fast. A traditional international wire can cost $20 to $60 in customer-facing fees plus hidden FX margin and intermediary fees. Settlement can tie up capital for 2 to 5 business days depending on corridor complexity. Reconciliation teams, compliance staffing, and error resolution add real internal cost per transaction. Now compare that to seconds-level settlement with algorithmic FX routing, reduced intermediaries, and no need to warehouse float in dozens of currencies. Even shaving 50 to 70% off cost per transfer at scale is material to bank earnings. This is why internal innovation leads and treasury teams are taking calls from Ripple and Stellar, even when public comms stay quiet. Banks are not blind. They're strategic. People say banks hate crypto. Wrong. Banks hate uncontrolled risk and regulatory fog. Give them a compliant, auditable, high-speed liquidity layer that improves margin and they'll adopt it, quietly at first, then competitively when peers move. Signals the insiders are watching. Pilot programs. Controlled corridors where XRP is used to eliminate pre-funding between specific fiat pairs. Stellar anchors scaling. Fintech partners and remittance operators using XLM rails to issue or redeem stable value assets tied to local currencies. Regulator sandboxes. Central banks inviting digital asset providers to test cross-border settlement under reporting oversight. ISO 20022 upgrade cycles. Perfect window to replumb payment messaging and embed digital asset hooks. When you see a bank file for digital asset pilot approval or announce a next-gen cross-border partner, translation: they've already run numbers and see savings. Central banks are signaling the shift. Survey after survey from international bodies has shown the majority of central banks, often quoted in the 80% plus to 90% plus range, are researching or piloting CBDCs, tokenized deposits, or stablecoin frameworks. Why? Because programmable money lets them improve transparency across borders, deliver wholesale settlement upgrades that match real-time domestic systems, reduce dependence on dollar clearing choke points, monitor systemic liquidity in near real time. When central banks move, commercial banks must interoperate. That's where standards-based, high-speed ledgers like XRP Ledger and Stellar become policy-aligned options rather than crypto bets. Ripple's institutional footprint. Ripple spent a decade building in boardrooms, not discords. Its network spans dozens of regulated financial institutions across the Americas, Europe, Middle East, and Asia-Pacific. Some use Ripple tech without touching XRP. Others are piloting or scaling on-demand liquidity, where XRP actually carries value between currencies. Ripple has also engaged with multiple government and central bank initiatives exploring digital currency issuance and cross-border settlement models. The legal clarity gained in the U.S., distinguishing secondary market XRP from securities treatment, removed a major adoption overhang for many observers. Doors that were half open are widening. Stellar's real-world rails. Stellar took the opposite route. Integrate where people touch money. Partnerships with MoneyGram open global cash in slash-out ramps. USDC on Stellar gives regulated dollar liquidity that can move cheaply across borders and settle into mobile wallets or bank accounts. Regional anchors issue fiat-tied tokens, bridging local banking systems that don't speak to each other. For institutions, that means they can reach emerging market endpoints without building full-stack correspondent relationships in every jurisdiction. That's last mile solved. Compliance by design. Why these rails win? Let's be blunt. Bitcoin is incredible as a censorship-resistant asset, but its volatility, throughput limits, and probabilistic settlement don't fit bank-grade payment SLAs. Ethereum's programmability is powerful, but base layer fees and congestion spikes are operational wildcards. Ripple and Stellar, by contrast, were architected around deterministic settlement, low cost, and traceable flows that can slot under regulatory reporting. Account models, transaction metadata, and the ability to integrate KYC/AML layers through network participants matter. Banks don't just ask, is it fast? They ask, can we audit it? Can we block sanctioned flows? Can we produce reports regulators accept? These networks were built with that in mind. From broken pipes to smart liquidity grid. If you zoom out, the story of banking rails is moving from fragmented pipes, each bank pre-funds each corridor, to an on-demand liquidity grid value teleports through neutral bridge assets and interoperable stablecoins. Imagine an FX router that routes liquidity, not just messages. Bank A wants to pay Bank B in a different currency. Instead of drawing from a dusty pre-funded pool, it sources instant liquidity via XRP. Settlement hits in seconds. Capital is free again. Downstream customers withdraw in local currency, or as a stablecoin redeemable anywhere. Stellar has an anchor. Capital efficiency goes up. Counterparty risk goes down. Settlement speed increases. And the institution that delays upgrading loses clients. Why they know it is the key line. You'll hear skeptics say, if the system's broken, why hasn't it changed? Because big systems don't pivot until paying inertia. That threshold has been crossed. Margins in payments are tightening. Fintechs are siphoning transaction volume. Regulators are codifying data-rich messaging ISO 20022 that rewards digital native integration. CBDC and stablecoin pilots are redefining good enough speed. Inside banks, the memo has already gone out. Upgrade rails, cut cost, unlock liquidity. That memo has the names Ripple and Stellar on the vendor shortlist in more rooms than most retail investors realize. The banking system isn't about to break. It's already broken, patched together by legacy plumbing, trapped capital, and delayed settlement that no longer fits digital markets. COVID just ripped the cover off. Since then, institutions have been re-architecting in plain sight. Standards upgrades, sandbox testing, digital asset pilots, stablecoin integrations, wholesale liquidity trials. That's the setup. In the next section, we'll break down why XRP, XLM, and compliant stablecoins check the boxes banks care about most: speed, regulatory fit, auditability, and capital efficiency, and why competing networks struggle to deliver all four at scale. Why XRP, XLM, and stablecoins are the only real options for banks. Banks want three things: speed, compliance, and trust. XRP and XLM bring all three. Speed. XRP's ledger can handle 1,500 transactions per second, settling in 3 to 5 seconds. Stellar is equally fast, optimized for retail-scale payments and micropayments. Compare that to Swift's 2 to 5 business days for international wires. It's not even close. Compliance. Both Ripple and Stellar have built regulatory relationships over the past decade. Ripple's legal battle with the SEC wasn't just a fight. It was a blueprint for clarity. With XRP now recognized as not a security, Ripple is free to integrate with banks without the legal gray area that scares institutions. Stellar, on the other hand, has been quietly aligning with regulators by emphasizing transparency and stablecoin issuance. Trust. These networks aren't trying to kill banks. They're designed to enhance banking infrastructure. RippleNet isn't replacing banks. It's giving them better rails. Stellar is doing the same for fintechs and cross-border remittance providers. Stablecoins like USDC and even bank-issued tokens will ride on these networks. Why? Because stablecoins need fast, cheap settlement layers. The ERC-20 Ethereum model is too slow and expensive for serious banking infrastructure. That's why Circle is now pushing USDC onto Stellar and even integrating with MoneyGram for direct cash-to-stablecoin conversions. The writing is on the wall. Every bank will need to either build on or connect to these networks. It's the only way they can compete with fintech disruptors like PayPal, RippleNet, and even central bank-backed instant payment networks. The global liquidity reset, XRP's sweet spot. We're heading into what many analysts call a global liquidity reset. The total value of cross-border payments is projected to hit $250 trillion by 2027. If even a fraction of that volume moves through RippleNet or Stellar rails, the demand for XRP and XLM will skyrocket. Here's the critical part. XRP isn't just a bridge currency. It's liquidity on demand. Banks and payment providers don't have to pre-fund Nostro accounts around the world anymore. Instead, they can convert fiat to XRP, move it instantly across borders, and cash out on the other side in seconds. This means banks free up trillions in dormant capital. Imagine being a bank and suddenly having billions that were previously locked up in pre-funded accounts now available for lending, investing, or whatever boosts profits. That's why institutions are salivating over Ripple's ODL. For Stellar, the liquidity game plays out with stablecoins. The Stellar network acts as a decentralized FX layer, where stablecoins representing different fiat currencies can be swapped seamlessly. The moment CBDCs go live, Stellar will be the backbone for retail-facing payments, while Ripple handles wholesale cross-border settlements. And make no mistake, this isn't a 10-year vision. It's happening now. Banks in Asia, the Middle East, and Europe are already piloting these networks. Japan's SBI Holdings is all in on XRP. Meanwhile, Stellar is being tested in Europe for cross-border remittances tied to SEPA rails. The inevitable bank adoption wave. Here's the part most people don't see. Banks don't innovate until they're forced to. Right now, stablecoins and crypto-native payment rails are eating their lunch. Look at what PayPal did by launching PYUSD. Look at Stripe and Visa, who are integrating stablecoin payments over Solana and potentially XRPL in the future. Banks can't afford to sit this one out. Swift knows it too, which is why they've been testing tokenized assets and CBDC interoperability. And guess which networks they're quietly evaluating? Ripple's XRPL and Stellar's network are on their radar. The ISO 20022 migration is the smoking gun. This global standard for financial messaging is the perfect bridge for digital assets. Both XRP and XLM are ISO 20022 compliant, meaning they can plug directly into the new financial rails being adopted worldwide. When banks flip that switch, they'll naturally gravitate toward the networks that are already compliant and battle-tested. And here's what nobody talks about: the cost savings. A bank using XRP for cross-border liquidity can cut transaction costs by up to 70%. Multiply that across thousands of transactions daily, and you're looking at hundreds of millions in annual savings for large institutions. We're already seeing partnerships emerge. Ripple with Santander, PNC, SBI, and even central banks like the Republic of Palau. Stellar's partnerships with MoneyGram, Circle, and potentially even major stablecoin issuers position it as the retail on/off-ramp banks will need. The adoption wave isn't just coming. It's here. The next 12 months. How to position now, not financial advice. Over the next 12 months, you'll see an explosion of headlines like Major Bank Tests RippleNet or European Banks Issue Stablecoins on Stellar. These aren't random pilots anymore. They're stepping stones to full-scale adoption. We're talking about a future where XRP becomes the de facto bridge asset for wholesale settlements. XLM and Stellar-based stablecoins dominate last-mile remittances and retail payments. Banks issue their own tokenized currencies, but they settle and interact through these networks. So how do you position? Education first. Understand which projects have real utility and bank-grade partnerships. XRP and XLM aren't meme coins. They're infrastructure. Second, watch regulatory clarity. The US and Europe are moving toward clearer stablecoin frameworks, and that benefits Ripple and Stellar directly. This isn't financial advice, but if history teaches us anything, early movers capture the upside when a system reset like this happens. By the time banks openly announce full-scale adoption, the price impact could already be priced in. The truth is, we're witnessing the largest transformation of banking infrastructure since SWIFT itself was born. XRP, XLM, and stablecoins aren't side experiments anymore. They're the future of money movement. If you hold XRP or XLM, or if you're just learning about the shift, now is the time to stay informed and not get shaken out by noise. Subscribe to Be Crypto Smart right now, because in the next video, I'm breaking down which stablecoins and tokenized assets banks are quietly integrating in 2025, and why this might trigger the biggest utility-driven bull run we've ever seen.